This program is brought to you by realestate.com.au, Australia's #1 address in property. With more properties for sale than anywhere else, we make it easier.
Thanks for your company here on Business Now. Every Monday, we're going to take you through the results of the weekend housing markets around the country. So let's kick it off by looking basically around Australia, where 80% of the properties that came up for sale were sold at auction. In Sydney, there were 223 auctions. The clearance rate there, healthy, 86.5%. Across New South Wales, there are also a further 1,531 private sales last week. In Melbourne, 295 auctions. The clearance rate here, 77%, a little bit above that. Across Victoria, another 1,261 private sales. In Brisbane, 56 auctions, almost 77% of those were sold. In Queensland last week, a further 1,368 private sales. In Adelaide, 52 auctions, 90% of those sold. SA is strong, and a further 390 private sales. In the ACT, 93 auctions and all but 5 sold. There were also 70 more private sales. And in Perth, just one auction. It sold, and 641 private sales across WA. Joining me now, Eleanor Creagh, Senior Economist with REA Group. And Eleanor, I've got to say, there's still a big appetite for property, notwithstanding all that talk about rising interest rates. And then even the big banks themselves suggesting in 2023 there could be an 11% drop in the value of housing.
Yeah, certainly right. I mean, we've seen that this year buyers are still pretty motivated. Certainly on realestate.com.au, we have seen the auction rates have trended lower since late last year, but that's to be expected given we've had a lot more stock come to market, a lot more choice. It's natural to see those auction clearance rates maybe easing a little bit. And, you know, 2021 was overwhelmingly a seller's market. But I think as we shift into 2022 and we are seeing that more stock's coming to market, there's a bit more choice out there for buyers. So that balance is maybe just starting to shift somewhat. But certainly buyer demand does remain strong, although it is easing off the very, very elevated levels we saw last year.
Do you might imagine that there'd be a lot of people who would be actually putting properties up for sale right now, trying to cash in on the elevated prices that are out there? But then the fundamental problem for them is, where do they go? You know, where do they live in the future? And then investors, of course, they might be coming in, but the truth is they've also got to anticipate that there are going to be rising rental yields into the future for them.
Yeah, I mean, you're exactly right. I think we are seeing that sellers are quite motivated to list at the moment. I guess there's a lot of people that might have held back last year. We're seeing that this year is very much looking to be restriction-free, so people have more confidence to list. We were also seeing that sellers are, of course, responding to the strong price growth and strong demand that is out there. But I mean, yes, you're right, investor activity has picked up significantly as well as the international borders reopen. We've got international students and skilled migrant workers set to return. That's likely going to buoy rental prices in the inner city and CBD markets, which haven't done so well throughout the pandemic. And I think certainly if we look at the moment, the house price to unit price discount. So units are historically cheap relative to houses. And that, again, is probably going to buoy investor demand a little bit, particularly as those rental pressures emerge. So I think, you know, all up, we are still setting up for a strong year for the housing market. Certainly, we've got a lot of people sitting on a lot of equity. And, you know, that's going to be underpinned by this ongoing lifestyle reassessment that we've seen with the pandemic. And I think that in itself as well is going to support transaction volumes in the year ahead.
OK, if we go back, say, 4 to 5 years, it's not that long ago, really, when there was enormous Chinese demand for Australian property. And as a result, we saw incredible amounts of development, especially in the apartment residential type areas. The one thing is those cranes largely have disappeared now. And yet you see with the appetite for new property, eventually there's got to be development that actually starts again. It really has to be the thing that satisfies the demand, and also for the price rises that have been seen over the past 12 months to 18 months.
Yeah, certainly right. But I mean, I think when we look at what's going to happen in the housing market over the next, say, 12 to 24 months, a lot of what we're going to see unfolding is going to be to do with interest rates. When we look at the big banks' forecasts on interest rates, they're maybe a little more aggressive than we are. So we're not expecting the RBA to hike rates as soon or as quickly as some of the big banks. And I think that allows, I guess, the housing market to extend a little bit longer. And I think certainly when we look at the RBA, they're really waiting for wages growth. And that's missing in action maybe at the moment. We see in the latest wages data as well that really the impact of the pandemic is just rife there. So we're starting to see wage pressures pick up in construction. We know that that's been buoyed by government stimulus and also scientific, professional and technical services. This has also been impacted by the fact that the borders have been closed and there's been a shortage of skilled workers in those sectors. So I think that the RBA are really going to be looking over, say, the next few months for those wage pressures to really emerge, to see sustained inflationary pressures, not inflationary pressures that are coming about due to the impact of the pandemic. And we're certainly not in that place yet. So I think, we'd be looking for wages to be rising significantly over the next few months if the cash rate were to rise this year.
But there's one oddity in that, and that is that the pressure for wage rises is going to come as a result of the increasing cost of housing, be that rising rents that you're talking about, or indeed if interest rates start to rise, which increases the cost that consumers and people are having to pay for their housing. So it's almost as though one is following the other to a certain extent, isn't it? And already we've seen an increasing cost of housing simply by virtue of 20% rises in our capital cities.
Yeah, I mean, that's certainly right, and that will feed into CPI. But I think when the RBA unpack this data, what they're looking for is sustained inflationary pressures. Sustained inflationary pressures come from demand-driven inflationary pressures, which comes as a result of wages growth. So the RBA are going to be, really looking for that, I guess, plus 3%, 4% wages growth before they even think about raising rates.
I'll tell you, it's going to be fascinating to watch it. And Eleanor, Creagh, we'll catch up with you very, very shortly and just try and keep ourselves across these housing markets during the course of the year. Eleanor, Creagh there from REA Group.